In this video, we are going to talk about Lucid Motors and CCIV, where things currently stand, where they're likely going to go, and if you should buy the shares. Before today's video begins, if you like my content, please like, comment, and subscribe to my channel. Lucid Motors is an EV startup. Its target market is the high-end segment of the EV sector and has a team with robust expertise and product to attract both clients and investors. The car that Lucid Motor is developing has a longer range than the best of Tesla, the technology to drive semi-autonomously, and the quality that a luxury brand can offer. When rumors started from a Bloomberg terminal that Lucid Motors may go public via the SPAC CCIV, its stock price started to go up significantly, from $10 to around $22, which means that the SPAC has a premium of $12 above its floor of $10. This enormous price increase shows that there is a lot of interest from the investors towards this EV startup in particular. In fact, many analysts believe that Lucid Motors may become the third major winner of the entire EV stock bullish trend for the next few years, after Tesla and NIO, because the company has a very optimistic outlook in front of it and has very high standards to back its ambitions. That being said, the question that everyone is asking themselves is whether they should buy the shares of CCIV, and if it is too late to participate. Because CCIV is currently just a SPAC rumored to merge with Lucid Motor, the problem has two layers. First of all, at this stage, CCIV is just a special acquisition corporation. It is not Lucid Motors yet, and there is no confirmation that can guarantee whether the deal will go through. When asked about whether they are planning to merge and bring Lucid Motor public, both companies neither confirmed nor denied. Usually, this means that the negotiations are still underway and that the deal may still collapse. There are, nevertheless, a few hints that we can identify from the published articles about the whole story so far. First of all, the owner of CCIV is well known and has a good reputation in the financial community. If the deal is completely fictive, he may probably choose to publicly deny those rumors, because that honestly makes the actual merger of CCIV very underwhelming. He would probably also do this to protect his own reputation and to prevent others from criticizing him as a fraudster. Another indicator is that Lucid Motors recently began hiring associates to handle the process of going public. This means that the company is certainly going to become a publicly traded company, and the fact that they did not deny the rumor with CCIV merger means that the talks definitely took place, and I believe that they are at least in an advanced stage. Personally, I believe that even if we put aside the factors of ethics and integrity, CCIV would have a lot of incentives to make sure that the news circulating around it do not harm its financial interest. After all, a company does not benefit directly from an increasing share price. The company does not sell shares every day. And if the rumor is later found out to be false, there may be a huge capital run and maybe even investigations from the regulators. Those are the things that all companies and their owners want to avoid, because they would deeply damage their relationships with their peers in the industry as well as their reputations. I don't believe that they would simply do that for a premium of $12 a share. Of course, at this stage, it is still possible for the deal to not go through, because there may be disagreements between parties in a negotiation. This is similar to what happened with Bridgetown, another SPAC backed by Peter Thiel that wants to merge with Tokopedia, an Indonesian e-commerce startup. The share price began to rise when rumors surrounding the merger went out, and the share price began to rise when rumors surrounding the merger went out, and it also collapsed when there were rumors that it may not go through because there were no more updates and announcements from either side. This is actually an argument of an article that many of you probably read in the past few days. It says that the stock of CCIV is simply too risky to buy in because there is no confirmation that a merger will go through. However, the article also said that we should definitely jump in as soon as the merger is confirmed. This brings us to the second issue, which is the risk control. Risk management is very important in all circumstances, but it is especially crucial in the case of CCIV due to the uncertainties surrounding the merger. An example of this is the promotion by many YouTube channels about the stock, stating that it is a golden opportunity to double, triple, or even more your initial investment. On the surface of the things, this is true, especially considering that some have been buying the stock since its price has been around $14. It is quite another story now that the price has reached above 20. Indeed, because the price has changed so much in such a short period of time, the risk to see a price reversal that may affect the long position if you decide to buy the stock now is far higher than the probability just a week ago. Another factor to consider is the actual exposure that should be chosen. The risk is radically different for someone with a position in CCIV corresponding to 50% of its portfolio versus someone with only 0.5 or 1% in it. Given the current situation and my analysis, my recommendation is to buy the stock, but with some specific suggestions for the execution. First of all, it is very important to build the position slowly and not to buy the maximum allocation in one trade. The stock price is currently very high in a very short period of trading time, which would normally suggest imminent price correction. Of course, we know that those corrections may never occur since this stock is still in the early phase, but it remains a plausible possibility regardless. Also, it is very important to keep your position within the allocation that you believe is appropriate for your own situation. My suggestion is to keep this trade within 1% of your portfolio as long as the merger is not confirmed. If the merger is later confirmed, the allocation can then be increased to 5% of your portfolio. Thank you very much for watching. If you like my content, please like, comment, and subscribe to my channel.